Okay, let's answer some questions from the last market outlook. I think there's a lot of them this week. Really loved your paper commentary, academic discussion. Would love to see more of it regularly. If I come across interesting ones that are timely, most certainly. Guru Purnima. Oh, this is the Indian festival, right? Where you thank our professors and teachers for their efforts in imbibing knowledge. Well, you're welcome. I think I had a couple of those on LinkedIn as well. Let's see. I'm mumbling to myself because I'm seeing if there's a question here. How long did it take you to become an expert? Well, I wouldn't even say I'm an expert yet. It is never ending. Just when you think you know something, the market will teach you something you don't know. There's always something you don't know. But I've been doing this for, I don't know, going on 25, 30 years. Seriously, though, with discipline. Like for the first 8 or 9 years, you just bumble around, picking up little bits of information here and there, but really giving it discipline, reflecting on yourself and really giving it discipline, about 20 years. Do you know any textbook series that goes into depth into every industry? No, I do not. One book on entertainment, one book on housing, and so on. No, I don't know one book that does it all. And to find something that goes into depth in those particular industries, you're better off looking for a .org, some industry.org. So whatever the trade group is for a particular industry, that's probably your best source of information. What advice do you have for someone who wants to be as knowledgeable on an industry as you are on housing? Read. Not everything you read will be true, but as you keep reading, you'll be able to spot the things that are true versus the things that are not true. You simply just start. You start reading and you start learning. Nice read about corn versus soybean growth and comparative pollination periods and yield responses to precipitation. That's detailed. I'm sure futures reflect expected weather, but given the past 10 years, the range around weather expectation appears to have increased. Corn sure does appear to be a more delicate balance, too, with regards to relying on weather. I see that as supporting your thesis on corn. If you're interested, have a peek at USDA ERS. I do go to that site quite a lot, the USDA. And I have seen the recent reports, and the expectation for weather seem right now rather favorable for both corn and soybean, at least in the states where they're grown. Let's see. I find myself glued to videos. I bought your course and I've learned a tremendous amount about real estate as well as measuring. Okay, I'll be interested in reading. I'm just scanning here for a question. I'm just mumbling to myself. I've been doing research on some of the REITs, specifically ABR and Agency, and looking through their 10Ks as well as some friendly help from Google Bard. I'm understanding the vast majority of the security instruments they're investing in are 30-year fixed loans. From an actual liquidity and balance sheet standpoint, does this mean they are less volatile to interest rate hikes? No, that doesn't mean they're less volatile. They use a lot of hedging instruments to make sure that their asset value is less volatile. Granted that homeowners and such can pay their rent. Oh, I think they're not invested in 30-year fixed loans. They're invested in mortgage-backed securities, and mortgage-backed securities hold those 30-year fixed-rate loans. And what mortgage REITs do is they tend to hedge out the interest rate expense, and they lever up the spread. From an actual liquidity and balance sheet standpoint, does it mean they are less volatile to interest rate hikes? Well, no, because the mortgage-backed security is a bond with a fixed coupon that will fluctuate in price as interest rates change. The homeowner is immune from the interest rate movements, but not the bondholder. I'm assuming REITs should have taken advantage of the 2 to 4% APR rate during the pandemic. Yeah, so I think there's a confusion about what REITs do, right? So you have mortgages. And these are homeowners. And a bank will take a whole bunch of these mortgages, pool them up, and sell them off to a government-sponsored agency. And they will issue mortgage-backed securities. And these bonds will have a fixed coupon. And the cash flow for these bonds come from the mortgages. as interest rates go up, the price of these bonds drop. So it is not as if agency can lock in low rate mortgages. It invests in bonds at whatever price the market is selling those bonds at. Will portfolio management seminar include any spreadsheet examples on how you track specific trades? To the extent that IBKR doesn't do it for me, then yes. But usually you can do a lot with IBKR in tracking your trades, especially in the way you count it in terms of, or you count your trades in terms of the order. So you can set up your buying and selling such that it's first in, first out, or last in, first out. Usually last in, first out allows you to be very strategic without affecting your average price. It'll take out the last average price that you put in, as opposed to first in, first out, where you're recognizing most of your unrealized losses become realized losses faster. So being that it has that option, I don't necessarily need a spreadsheet if I can use last in, first out. I will be pointing that out as I go through the course. I've noticed that HE futures are in backwardation. LE is in contango. This has widened the spread by 10 to 15 cents more than the front month spread. Is that not a positive for this trade? Well, I understand that expected supply influences these futures curves. In this case, does this create a sort of negative carry type situation? Well, I'm short LE, so if it's in contango, good enough. I'm not too worried about the shape of the curves on this one because it's a pairs trade. I'm short LE and I'm long HE, so I'm good with that. The December spread is larger than the front month spread. So if it is the combination of the two positive carries by being long something with positive carry and being short something with negative carry, which makes it positive, then great. That's it just adds to my favor. But it's the price differential you'll see in the grocery store, the 50 cents on the animal, a 50-cent spread on the animal. That's not the same as it being a 50-cent spread in the grocery store. It's much, much wider than that because the yield for a hog is much higher than a yield for a cow. So by the time it ripples through to the store, the differential in price is huge. 50 cents is usually a mean reverting level of the spread between hogs and cattle, only because supply and demand dynamics in the grocery store play out. So once you get it through the system, demand for pork will increase at the expense of demand for beef. Cap rate looks rather expensive right now, given that G outlook doesn't look amazing. Occupancy extremely high and nowhere to go, and are increasing with real rates. I'm failing to see the light on your interest in this one right now. If you look at its growth rate in NOI, same door NOI, it's quite robust. And their dividend payout ratio is low enough such that they have, as far as reinvestment goes, they have lots of retained earnings for reinvestment because they have a decent enough depreciation shield such that their net income is low. Cap REIT, all REITs got to pay out a certain proportion of their net income, but the difference between their net income and their cash flow is significant because of that depreciation. So if you keep newer properties on your balance sheet, you can still satisfy the requirements of a REIT while retaining significant income. So just the income that they can retain is decent enough. And apartment REITs still are, of all the commercial real estate sectors out there, it still is considered the one with the lowest cap rate, or that justifies the lowest cap rate. But as the price of cap REIT goes up, it becomes less and less attractive. You know, as it comes down, it becomes more and more attractive. But it is held up fairly well over the last little while. If it drop, I keep selling, whenever it drops, I keep selling $48, $47, $46 puts. And I think it's over 50 now. 50 and change. On any weakness, if it pushed back down to $48, $47, I would do the same thing. I would sell as many puts as I can. Not the most liquid puts, unfortunately, but you do get them. Just if you got to get out of them, you're probably not. So you kind of have to own it after. Given the sheer size of long-only funds out there, the hyper-opportunism of retail bulls, and now the idea that tech is a safe haven sector in equities, is there still not a serious sentiment-driven risk to that short ES? Yes, there is. I agree with you. It is mini momentum that is building up there. Still licking my wounds and feeling pretty queasy on stepping back in front of that momentum. Just 2 weeks ago you were neutral, but now most indicators are flashing positive, yet you're back in your short position. Are you not worried about momentum any longer? Well, yeah, I am worried about momentum. I have long positions. You can manage a position or you can manage a portfolio. So at the level of the portfolio, I'm rather neutral, but I still have my short position only because I have long positions. But the more I reflect on what I'm seeing and the more I think this thing through, the more things just don't hold together. When something falls apart, and then after we all say, well, we should have seen it coming. I mean, the contradictions that were there just didn't make sense. How could we expect something like that to just continue on? And it all seems obvious in hindsight, but from the vantage point here, it doesn't seem very obvious that the trade is to the downside until it does go to the downside, and then there are plenty of reasons why it should have. Now, if I can't find plenty of reasons why it should have, then I'm in the wrong trade. But I think, as a thought experiment, if the market did drop 200 points over the course of the week, what would the story be? The story would be, well, rates are going to be higher for longer. Unemployment is at a 50-year low. Don't expect rates to be cut at any point in time. Bankruptcies among small businesses are rising. The quality of earnings is the lowest it's been in 30 years. The number of unprofitable firms in the Russell 3000 is at elevated levels, and every quarter interest rate swaps and interest rate hedges roll off, and companies have to now start reporting or using the higher, they have to reset their interest expense at a higher level. You have had no growth in cash flow. Year over year, cash flow from operations is actually lower, while net income is actually higher, which speaks to the quality. That would be the story. There'd be no end to the reasons why you sold off 200 points. And because of that, yeah, then I don't mind being short. But if I have to scrape around for a reason why it sold off for 200 points, well, then maybe that's not the right move. But right now, all I have to say that we're going higher is, sentiment, AI hype. The backdrop, the economic backdrop, the fundamental backdrop just isn't there. In fact, the backdrop is counter to continued earnings expansion. It is counter to it. I'm really just fighting. I'm really short. I'm not short anything more than fundamentals and hype at this point. And the fundamentals of the economy don't support this multiple, a 21 times forward multiple on as reported earnings. 21 times while rates are increasing and money supply is shrinking. 21. So that's why I continue to be short, but I have the fortitude to do it. I'm comfortable doing it. If Japan was to announce its departure from yield curve control, what global effects are likely to take place? Well, the yen would rally, and that would start to unwind the carry trade with the weak hands folding first. The stronger hands may say, well, we're going to be okay for a while. Those that have hedged quite a bit might say, well, we're okay for a while, but it would rally the yen, which probably would reverse some of the gains in the Japanese stock market, but I don't think it would be a contagion effect anywhere, and which is, I think, what you're asking. Curious to hear your thoughts on recent Q1 GDP revision up more than expected and its effect on the market. Yeah, that on the market outlook, I did say that that's a bit of a curiosity. Usually that third look, because you get 3 looks at GDP, usually the final number has some small adjustments, but to have a major adjustment like that, that tells me that the data or the methodology is contaminated with something. Something fundamentally different is going on in the economy that is making the old models pick up signals that it shouldn't be picking up, or the old models simply are not working. Because imagine, and we've seen this for quite some time, imagine a situation where you have a bunch of analysts from a bunch of firms giving their forecast. Usually, the forecast over time falls in the middle of that distribution. But we haven't been seeing that lately for quite a bit of the data. It hasn't been falling in the middle of the distribution. So you have some forecast, and you have all of your analysts that say, well, I think it'll be something like this, right? And you get a number. I'll use a different color for that. You get a number. The next time they have the forecast, you get a number. 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 But over time, they tend to fall in the middle of the distribution, that if you took the average of all the analyst estimates and the actual data, it would have the least amount of variability versus each individual, the level of variability from each individual versus the actual. That's why we call it the wisdom of the crowds. But what we've been seeing lately is a distribution of forecasts, which we always have a distribution of forecasts, and the data comes in, and the data comes in, and it comes in, and it comes in, and it comes in, and it comes in, and you're getting, when you see something like this, you say, well, that's a bias. That there is some bias in the estimates. Either there is bias in the data, or there is bias in the estimates. Because, you would expect that the actual would come in somewhere in that distribution. But when it comes in, sometimes it comes in like out here, way out of where analysts are forecasting. And it's not just, the forecast or the expectation for GDP. It's the expectation for, and we've seen it for new home construction, for the home builder diffusion index, for initial jobless claims, for a whole bunch of different data series. You're starting to see a whole bunch of bias. So, the question is it the data, or is it the method? Is it the models? I don't know. That one I don't know the answer to. But to have a revision on the final look go from 1.4 to 2%, you kind of have to say, is it the data, or is it the methodology by which the data was collected that is wrong? To keep saying, well, all the analysts got it wrong all the time, all the analysts are always wrong, is to sort of say, well, we believe the data. And well, what if the data collection is picking up something that it shouldn't be picking up? What if there was a significant shift in the economy that is not being accounted for? What if there's a variable in the data now that is not in one of the models, right? Then it would produce an estimate of GDP that is curious, that you look at and you say, well, that seems odd. Again, that seems odd. So because there is this bias going on, it does raise the question, which is to blame, the data collection and presentation or the analysts, right? Do the analysts need to update all their models? Are they missing something and the data is right? Or is the data collection missing something and the analysts have sort of figured it out and the data collection places need to do something? I don't know the answer to that. It's a good question, though. Let's see. Could you provide some commentary on the bank stress test from last week? I feel the market overreacted to all the large banks passing stress tests, even though they should pass given the size of their balance sheet. Yeah, well, banks, even going back to 2009, 2000, I'll say it, 2010, in the aftermath of that financial crisis, stress tests became a thing. And, it was never a surprise. All the banks passed all the stress tests every single time. Every single time they passed the stress test. So I don't know that they work. You cannot stress test me for something I expect. Okay? So if you're stress testing my level of anxiety by hiding in the house and scaring me to see how I react, and I know that you're doing that, I'm going to be prepared for it. You have to stress test me in an environment that I least expect, because I must grow accustomed to my environment first. I must grow into my environment. And once I grow into my environment, I would fail stress tests that push me outside of that environment. You have banks that failed a little while ago. So you have a lot of banks that have looked into themselves and have, tried to fix what needs to be fixed. And you have a system where liquidity is now being granted, and you're stress testing these banks. Precisely when they've unadjusted from their environment. Well, of course they're going to pass. The proper time to stress test is when no one sees any stress on the horizon at all. And when they're fully adapted to their environment, then you stress test them, because they're too tied to their environment. They've overfit themselves to their environment, then you stress test it. But not now. Banks are not overfitting themselves to their environment right now. So, is the passing of the stress test a function of banks being hyper vigilant now that they've seen a problem? Or is it that they're really just that good? Hard to pull that apart too, right? Really interested portfolio management seminar starting in July. It's starting July 17th. We're July 4th. I'm already working on the screens now. I'm scheduled for CFA Level 3 in September. As a provision to sign up for and access 4 weeks of content in September. Will the course run expecting week-on-week attendance. They're videos that I put out. It's, you can watch them anytime. You can start anytime. If you have, it might be worth it, to start when I start, because week after week you're going to see the live market data that I'll be using. You'll be in the environment, as opposed to, picking it up in October and having to think back, okay, so that was going on in July, that's what you did then. Making it harder for you to maybe see some of the things in what is going on in the market in October. Because in October, you have the benefit of knowing what happened. But at the time that we're doing it, we don't have the benefit of knowing what happened. But I'm doing it in such a way that it's not specific to any time period, but I do have to use some period's data, right? Seems like we're seeing quite a bit of complacency in the markets. Complacency, no kidding. Despite pretty tightening Fed. In the last few months, we've seen high beta stocks rallying, cyclical stocks rallying, home builders rallying, whereas defensive stuff like staples, dollar, gold, treasuries have been dropping or remain stagnant. Yes, I know there are strong currents like AI, tight home inventories, lagging effects, but I was wondering, is the Fed perhaps failing to truly tighten the financial conditions and to drain liquidity? Are there perhaps some hidden fiscal or monetary accommodative mechanisms running on the surface counteracting the Fed's efforts? Yeah, there are. The Inflation Reduction Act is pumping and going to be pumping a lot of money into the economy. There is still, I think, some pandemic relief benefits, tax benefits that are still being doled out, and it's not a small amount. Apparently, it's quite significant. Another big trend that I've noticed, and I was going to put this in next week's market outlook. Well, I'm going to, but I'll mention it here. Is I've been through a number of companies' 10Qs from Q1. And I'm seeing a common theme, voluntary retirement. In reducing headcount, rather than do layoffs, it's voluntary retirements, and of course you get your payouts. Well, these people don't go to the unemployment line, right? They retire. And what happens when you retire, you have your portfolio. Instead of money going in, money starts coming out. And you're in disbursement mode in your portfolio, and you start spending that money. And retirees, at least if you're taking early retirement, don't usually buy goods, and they buy services. They buy experiences. They travel. They do all sorts of things. Well, that fits with what's going on in the economy right now, is that you have robust consumption, but you have manufacturing PMIs in contraction. You have retail stores saying, it doesn't look that great. Walmart, Target, lowering their forecasts for what they expect. The goods side of the economy saying, it doesn't look that exciting, but service is on fire. Well, this is what these people do. Now, companies are are paring down their headcount, but they're not laying off people. They're paying out people, and these people will then go and spend that money, and they tend to spend it on services. So we're not seeing initial jobless claims rise, and we're not seeing labor force participation rise, because once you pay them out and they retire, they're out of the labor force. So just as quickly as you're getting people in the labor force, companies are paring down their headcount by pushing people out of the labor force. And paying to get rid of them. You're seeing a lot of, we took a one-time charge of $36 million, $53 million, $200 million for these voluntary payouts. And these people are leaving, let's say white-collar management, 150 to 200K after a long career service, and these new people are entering at 80K, which otherwise might have cost 60K. So you've got wage inflation going on this end, but look at the difference between what you're paying, and you're sending these people out the door, and they're not unemployed. But you're giving them a big payout, and there is a source of money that is finding its way into the economy without finding its way through payrolls, if you get what I mean. It's part of their retirement plan. It's part of their savings, so it's not showing up in incomes. There is a lot of that going on. Just grab a 10Q at random from any of the S&P 500 companies and look for or scan for voluntary retirement and see what you find. It would not surprise me if quite a few companies are doing that. Rather than laying off people, let's reduce our headcount by paying these people out, and that is keeping labor force participation down. So I think that has a big role to play. So that could be happening underneath the surface. TLT. In a higher for longer environment with stubbornly sticky inflation, resilient economy and job market, TLT would seem to benefit in a hard landing scenario. Yes, it will. Basically, for TLT to thrive, a recession will need to materialize in the near future. Not just a recession. Something big must break. The Fed's not going to cut in a recession. If it is a mild recession, the Fed's not going to cut. They're not going to cut because you have a tight labor market. You cannot cut and encourage more growth in a tight labor market, because inflation will just show up again. You must introduce slack into the labor market. In other words, you must flatten the labor supply curve. It's too steep right now. So it would require something significant breaking, which if you keep rates higher for longer and you push them higher, you are going to break something. It is inevitable that something breaks that would be a contagion. It is inevitable that something breaks. Let's see. Need to materialize worsening corporate earnings. The Fed's not going to step in and stop corporate earnings from dropping. Unemployment numbers. Unemployment would have to be above 4.5 before the Fed starts to worry about it. I see and agree that due to the lagging effect, such scenario seems like the most likely outcome. However, we've been getting robust macro data lately, including a monster revised 2% GDP. Even XLY is rocking off. Well, what we've heard many times is the stock market's not the economy. So when the stock market was selling off, people were saying stock market's not the economy's doing just fine. Now that the stock market's roaring ahead, I do need to remind those same people the stock market's not the economy. That does not mean the economy is roaring ahead. It means the stock market's roaring ahead. Okay, the economy will be what the economy will be, and markets are just a reflection of the sentiment of people. And right now, I think it's wrong. Is rocking off for Pete's sake. Yeah, Pete. Perhaps the economy's outlook is not as grim as logic would dictate. Perhaps. Perhaps it's not. If you have we keep hearing that there is this massive amount of wealth owned by the baby boomers. And over the next 20 years, there'll be this massive transfer of wealth from the baby boomers to their kids. Well, if there's this massive amount of wealth with the baby boomers and they're all retiring, then they're spending that massive amount of wealth. So maybe you don't need an economy to create as many jobs for there to be as robust spending in the absence of it. And again, the retirees are not buying stuff. They're not out in the malls buying stuff. They're buying experiences, which would help explain why services and the services side of things are on fire. So it could be that with all of that spending that the baby boomers are going to be doing, why leave it to my ungrateful kids when I can spend it and have fun? And that's assuming, of course, that they spend it domestically. I mean, if they start traveling the world, then it's some other country's GDP, right? Because you are exporting, other countries are importing tourism. So it is some other country's GDP. So if they travel mostly in the U.S., well then it's America's GDP. Could be, yeah. You could design all sorts of scenarios to explain how the economy could be okay. However, it becomes much more difficult when you say with interest rates 500 basis points higher than the last 15 years, with credit being much tighter. With unemployment or bankruptcies among small businesses rising. When you start listing the economic backdrop that we have, it is not conducive to growth. And at some point, cash flow and net income is going to have to close that spread. It can't keep widening forever. It's just worsening earnings quality. It's going to have to close that spread. It is more likely to close it by net income dropping than cash flow increasing. So it's hard to tell a story right now because you can make a really good bull case and you can make a really good bear case. And if I told you the bull case, you'd say, yeah, I'm on board. And if I told you the bear case, you'd say, yeah, I'm on board. Well, there we are sitting on the fence. And no matter what side you fall on, it feels perfectly okay, right? So what do? It is a tough call right now. Would you agree with the following? Usually at late expansion, fiscal policy should be deleveraging. Yes, it should. But with those crazy high deficits and real GDP growth, it's likely that those loose fiscal spending is keeping the economy afloat for a while. Yes, I agree. And if they started stimulating anticipation of a slowdown, well, that's it. The fiscal is the wild card, right? It's the wild card. I think that Western governments have become far, far, far too comfortable with deficit spending and this idea that it pays for itself, that it can continue to pay for itself, that even if we promote inflation, inflation raises tax revenues. So if we create 5% inflation, well, prices are 5% higher, wages are 5% higher. We're taxing that higher number. GDP is 5% higher, and we collect, let's say, 17% of GDP. Without raising tax rates, we can raise tax revenue. So we end up paying off that debt because our revenue is growing at 5% a year, and if the average interest rate on the debt is, if you look at capital market debt, the average interest rate is 4%, we're actually making money. It would be foolish not to issue more debt, right? It doesn't take much to convince a group of unqualified people unqualified to make these decisions. It wouldn't take much to convince a group of unqualified people that if they spent more money, it actually pays for itself and they'll get reelected. What's to lose? Your kid's future, not mine. Your kid's future, right? Governments are the wild card. You can't count on rationality with elected officials. You can only count on self-interested selfishness, which means that leans towards spending as much money in their district as they possibly can. screw the country, screw the taxpayer. I got to take care of me, and me needs to get reelected. At least for 6 years, or what is it, 6 years you lock in your pension? At least keep me in power for 6 years. I think in Canada it's 6 years. If you're elected official, you get your pension. So you'll screw everyone over if you can stay in the game long enough just to get your pension, then you don't care. I have a question. Would a rally in the financial markets affect inflation? It could, and there are two arguments of how that could affect inflation. Number one is the wealth effect. When people feel richer, they tend to spend more of their current income. So with portfolios down and stock markets down, you have income earners that are saying, well, we better put more money into our savings if we're going to hit our retirement plans. But when markets are up, you have households saying, well, you know what, the market's doing the heavy lifting for us. Maybe we don't need to save as much as we thought. So they start spending more. Actually, I should put a C for consumption if I'm going to be consistent. They start, and I should make that an S. Oh, that was an I, sorry, and that's an S. There we go. Income, savings, and consumption. They start spending more. So the wealth effect could cause an increase in spending, a lower savings rate, and a higher marginal propensity to consume today. So there is one pathway in which it could promote inflation. Another way that it can promote inflation is by changing the debt equity ratios of companies, because you're using the market value of debt over the market value of equity. And if it's going up, leverage is dropping. And if leverage is dropping, companies can, even at these interest rates, issue debt to do share buybacks, thereby returning money to shareholders and making them richer, right? Anything that puts more money in the hands of shareholders, right? Let's see. Do you see any knock-on effects from the resumption of student loan payments in September for U.S. borrowers, either in reducing core PCE and or corporate revenues? Well, you're going to be taking spending out of the economy. You've got this resumption going on, but never underestimate the foolishness of government, right? The Supreme Court overturned Biden's loan forgiveness plan, which they should. You went to school, you took out a loan, you got the education. The benefits of that education will accrue to you. Why do 100% of the taxpayers have to finance the cost of your asset? If they do that, then I want mortgage forgiveness. Knock 10 grand off my mortgage. Knock 10 grand off everybody's mortgage. Knock 10 grand off everybody's debt. Why just select a few people who decided to go on to university? Why make the cab driver, the auto mechanic, the plumber, the electrician, why make all these people pay just the debt for just those people when they have debt? Hey, I got debt. Everyone's got debt. Why not just give everybody $10,000 off, right? So I think that was the right decision, not to pay just a select group of people's tuition. I think that's the right idea. They're going to have to start paying back their debt. So that money is not going to be spent in the economy. But keep in mind, if I owe you $20 and I don't have to pay you, I got $20 to spend in the economy. But if I pay you, you've got $20 to spend in the economy. It's not like that money disappears. So it belongs to somebody who lent it to begin with. It's somebody else's savings to begin with. So if I give you the $20 I owe you, I can spend $20 less, but you got $20 now. Right? So, they got to pay back their debt, but that debt was somebody else's savings. So money will just be returned to the person who originally, at some point in the process, put it up as savings, and it will find its way somewhere else. So it's not as if it's being sucked out of the economy. This group of people won't have it to spend, but that other group of people may have it to spend. Curious on if you perform any intrinsic valuation considering a position in an individual name. No, but not deeply. Not deeply. or do you put most of the weight on macro drivers? Mostly macro, and you support share price, stick with best in class. And if you do that, if you go with macro drivers and go with best in class, it does save you from having to do a lot of the deep dive yourself. However, if you're looking at an industry and there are 2 or 3 leaders and 15 followers, and you're thinking one of these followers are going to be a real knockout at some point, well, you got to do your legwork on those 15 followers, because you're making a micro bet. If you're making a macro bet, you can go to the level of an ETF like COPX, right? You can go to the level of an ETF, or you could just pick the biggest and largest FCX in terms of copper, right? And you just stick with best in class home builders. Lennar and DH Horton are the 2 biggest home builders in the U.S. All the home builders are on fire, by the way, but they tend to be safer bets. Yeah. Look at my menu system. I don't know why it does that. Every now and then my menu system jumps from one screen to the next. There, I've taken care of it. If I buy 300,000 euro worth of U.S. securities and I enter into a forward or futures contract for the same notional, am I effectively hedged against currency risk? To the extent of your original 300,000, if it falls to 250, you're over hedged, and if the hedge worked against you, you'd lose. If it goes to 350 and the hedge doesn't, and your hedge works, well, you're still unhedged by the other 50, right? Depends on what you're buying. Are there any costs, for instance, negative carry associated with a futures contract? Yeah, you'd have to look at where the differential in interest rates are, and there may possibly be carry. I don't know offhand, I haven't looked at it, but there will, because there are different interest rates between the 2 countries. If I'm correct, only the potential profit should only be subject. Oh, well, there you go. Only the potential profit / loss should only be subject to currency risk. Yeah. I've learned a lot about options on the applied series. However, I'm not seeing much content on trading futures and the associated margin requirements. I've done the 2 big ones, equities and treasuries. I've done the 2 big ones. Now I'm gonna, if you look at, if you go to the site for applied, the applied series, and you go to the main purchase screen at the very bottom, you'll see 3 PDFs, one in English, one in French, one in Mandarin. If you open that up, it'll give you the schedule of when I'm adding to each section. So I'll be adding to the futures section over the next probably 3-4 months. I was gonna save it for the fall, but I'm working on the grains right now. So I'll be adding some videos for, I'll probably start with wheat, because wheat is kind of the nicest one to work with. I'll add wheat, corn, and soybean, and then probably some energy stuff this fall. But this is an ongoing process. I will keep adding to those sections. Will you be covering futures trading in your upcoming IB portfolio management series? Yes, I will. Yes, I will. As I will show you how to gain exposure to a market using futures in a deleveraged way, meaning that you should have almost no carry by using the futures. I'll show you how to get that done. What are some strategies or considerations when you want to maintain exposure to an underlying? You're long in the money calls but don't want to hold the underlying. I'm thinking of stepping into a calendar spread shifts exposure from close date expiration to one further. Yeah, I get that. And if I'm curious if there are other ways, I usually do it when I want to avoid any currency risk, because if you do a synthetic, you can usually get into your synthetic for free. If it's a big dividend paying stock, you usually get a credit, which is a smaller foreign exchange exposure than you'd normally put out. Not only that, all the dividends are not subject to any withholding tax, because now they're all within the present value of the put. The present value of the continuously compounded dividend is in the put. And if interest rates are low, you'll get the whole dividend in the put. As interest rates go higher, yeah, you lose a bit of that dividend because the synthetic will be centered around the forward price, not the current price. now you don't have a dividend, you have a capital gain with no withholding. So on an after-tax basis, it's far better. I was thinking about buying INDA ETF. India is a beneficiary of U.S.-China tensions. Companies are increasingly looking to manufacture in India, and their GDP growth is 7.2. I'm worried about the weakness of the Indian rupee, which would deteriorate the performance in dollars. Yeah. First, what are your views on investing in India? And secondly, is there a way of reducing the effect of local currency depreciation? Well, how long do you want to be in India? If you say 6 months, well then, yeah, you got to worry about the currency. If you say, well, I don't mind converting some money into rupees because, if the Indian currency is really weak right now, you'll get a lot of Indian rupees. And I'll just keep reinvesting I'll just keep them in rupees and keep investing in the Indian market for the next 5 years. Well, then don't worry about the currency because you have a long period of time to deal with it, and currencies tend to revert to their purchasing power parity levels over mid to long-term periods. So, for example, I have money in the U.S. and I do hedge, but I'm not that fanatical about the hedging with my U.S. dollars. Because I plan to invest in the U.S. for years to come, in which case I don't have to convert my money back to Canadian at any point in time until I want to convert it back into Canadian, which I'll sneak something out here. I'll probably never convert back to Canadian because I am in a little bit beginning the process of immigrating to the U.S. I've had it with Canada. I've had it with the healthcare system that makes me wait 2 years, and I've had it with the 53% tax rate in return for waiting 2 years for healthcare. So I just feel that Tennessee or Florida sound like two great states with no state tax. I end up with more after tax that just over a 5-year period, the savings in the after tax buys a really great house. In other words, I'd be getting it for free, relative to staying here. So yeah, little peek ahead in my life. Okay. Let's see. Quick question about the last Q&A. When you mentioned your year-to-date performance is similar to SPY, did you mean for your total amount in IBKR or just the amount you invested? The IBKR amount, correct. To be clear, let's say your account is 20 million, SPY year to date is 15. Does it mean your performance is 3? If we're going to use those numbers, correct. But let's. I had this question before. Did I beat the market? I can't answer that question. And let me give you an analogy because I thought about this. How would I explain to somebody who doesn't quite understand the idea of benchmarks? Because I did try to explain the benchmark, and I remember one comment was, come on, you're being cagey. Just tell us. Just answer it, You're losing credibility. Let me tell you about my strength. I am stronger than the average of all the 5-year-olds in the city. And when you take all the 5-year-olds and you figure out how much they can bench and you take the average, I am stronger than the average of all the 5-year-olds. Just to give you some idea of the sheer strength I have. Now, I know some of you are saying, oh, come on, that's the wrong benchmark to use. You should, it's the wrong benchmark to use. I should be gauging my performance against a benchmark that is more relevant for me. In other words, I should take all the people my age and take their average bench, and then I can say something that means something, right? So if I'm investing in, or you don't invest, you trade, but let's say you're in copper, you're in wheat, you're in the Japanese yen, the Mexican peso, you're in bonds, you're in a whole bunch of places. Maybe you've got a few securities in the S&P 500, you've got Canadian banks, would you then say that the S&P 500 is the right benchmark for me? Probably not. What you have to do is say, okay, you're in all those different things. Let's find a passive investment that has all that stuff in there. And the proper question is, could you have beaten a passive investment with what you do? Now, your benchmark has to reflect what you're doing, much like my bench pressing benchmark cannot use the average of 5-year-olds. It's not a correct benchmark to use. Of course I can beat it because I'm outside of what that benchmark is. So it's the same with the S&P. The SPY, if you say, did you beat the SPY? First of all, is the SPY the proper and appropriate benchmark for me? Anybody with a charter out there or anyone who's been through level 3 will be nodding their head saying he's right. You have to look at his performance based on what his benchmark would be if a benchmark existed. So if I were a bond investor, would you say, did you beat the market? Well, which market? The bond market or the stock market, right? So I just want to put that out there, that when you ask somebody, did they beat the market, first ask them what market they're in and ask them if they beat an appropriate benchmark for the market that they're in. A 5-year-old benchmark is not an appropriate benchmark for me. I think you get that, right? Would be interesting to see your take on data coming from Europe. Seems to me this recession, depression, crisis will all start here. Variable rates on housing and high energy prices. Yet, I believe the Stocks 50 index is near multi-decade highs. Japan's markets 30-year highs. U.S. is 7% below all-time highs. You have to stop and say, what the hell is going on? I think we must come to the conclusion that monetary policy doesn't work. It just doesn't work. It's something that happens in the background and we think it works, but it really doesn't work. It would be like me hopping on one foot and all the time saying a land war in Europe is coming, a land war in Europe is coming, and when one shows up, I say, aha. And you say, wow, come on. And then I answer, I'm sorry, but my technique works with long and variable lags. Well, as soon as you say it works with long and variable lags, if the economy is cyclical, eventually you're going to get the outcome that you think you're engineering. 30 years in Japan of ultra-low interest rates to try to get inflation and nothing. Money printing galore to get inflation and nothing. And it's just recently showing up, and it's not even over 3%. It's just recently showing up after 30 years. 500 basis points in 1 year, and you have stock markets that are just below all-time highs. In other countries, hitting all-time highs. Things are on fire. The multiples at 20. I think at some point we have to say, look, either there's way too much money in the world, way too much liquidity, and it has to go away fast, or this stuff doesn't work. Japan can't seem to get inflation, and it lowered rates to almost nothing for 30 years. And here we're trying to slow down economic activity by raising rates, and it just doesn't seem to be working. In Canada, you have rents in Ontario that are up 30% year over year. Rents in a couple of states in the U.S. are hitting all-time highs. Housing prices going right back up. Maybe this stuff just doesn't work. And we think it works. And when we say it works with long and variable lags, at some point there's going to be a recession, and the central bank can say, see, told ya, that maybe if you got rid of central banks all over the world, you'd see exactly what you see now. I don't know. What do you think? So the data coming from Europe, I don't know. Recession, depression, crisis will all start here. Thank you for sharing your knowledge. I would like to know which podcast you would say are worth listening to. It can be about anything, not just about the market. I like the All In podcast. I like Princeton's series. And Goldman Sachs has great talks. Chicago Booth School has great talks. I like those. You mentioned companies rolling over the swaps will be hit with a 500 basis point hike, but wouldn't they have any swaps deployed intermittently to offset this large difference? If you look at some companies, I've been looking at a number of banks and a number of other companies for their swaps that are in place and when the swaps are rolling off. And you can see that they have been putting new swaps on that are, some of them are 300 basis points higher 350 basis points higher than the ones they had on previously. When you had a fixed rate on a 5-year swap that was 80 basis points, and you're putting new swaps in as those ones roll off, you can see that they were put on maybe 6 months ago and are sitting at 380 or 400 basis points. They're already, each quarter that goes by, there is a number of swaps every quarter that expire that need to be renewed. So every quarter you have this slow creep of rising interest expense. When you want risks, okay, I've read that one. Refinitiv data shows that roughly half of Japanese companies trade below book value, and roughly half of the cash on their balance sheets after subtracting liabilities. Also, there are tax incentives starting in January that encourage Japanese citizens to move their money from cash into investments. Do you consider the Japanese market as a good investment at this time? Would a hedged or unhedged currency position be preferable? Given the low level of the yen right now, I don't think I would hedge. If you buy the Japanese market, convert your money into yen and invest in the Japanese stock market on a yen basis, not on a dollar basis, on a yen basis. If this is something, then that carry trade is going to reverse very quickly once yield curve control is over. The yen should appreciate quite significantly. So I don't think that I would hedge if I owned yen. But don't own yen and leave it in yen in your account, because there is an interest rate that you're going to be charged because it has negative interest rates. You can't hold a yen cash balance. You got to buy something with it, right? Is it not entirely possible the market is looking past all these doom scenarios and letting euphoria grip the market sooner rather than later? Yeah, that's exactly what it's doing. It's exactly what it's doing. But in looking past something, you're assuming that there is a linear path, right? Let me draw that out for you. So here we are, and you're saying, well, there's this unknown valley in here, right? Where things could be okay or we could drop. So I'm going to look past it, and we're just going to continue on over here. Well, you're assuming that whatever happens in here doesn't fundamentally change something such that this then becomes the path, right? By looking past something, you're extrapolating the path to just pick up at some point in the future, kind of along a straight line where you left off. But what if something changes and the path itself changes trajectory? How does the Treasury actually calculate the yield curve? If you go to treasury.gov, click on data, scroll down to the very bottom of that next screen, you'll see methodology. Click on methodology and you'll be fine. Or I've already replied here with the link to the methodology. TLT. I get the justification of going along TLT at this stage of the rate cycle. But even if you stay, we believe rates to be much higher for longer. So that in mind, why go along TLT right now instead of waiting for a few more Fed interest rates? What interest rates are going to do is invert the curve even more. That's all it's going to do. I don't think it's going to significantly raise the long bond yield. I think it's just going to invert the curve even more, because if you go higher, there'll be a belief that you're only going to break something, and money will start, the higher money market rates go, the more money will go into long duration. And I think that you'll just end up with a much deeper inversion. Where were we? You mentioned money was flowing out of money market funds to go into the capital market as investors are adding duration of their fixed income investments in anticipation of a steepening yield curve. Well, the evidence is consistent with that story, at least the evidence I've seen. Could you please explain graphically the intuition behind that with the current inverted yield curve? If something big in the economy breaks and the Fed decides to cut rates, wouldn't you profit more if you're invested on the front end of the curve? Well, the front end of the curve has no duration. Duration is not a measure of time, by the way. Duration is a sensitivity to changes in interest rates. So the current yield curve is elevated. It looks like this, right? And these are your money market rates, which will reflect Fed activity. These are your capital market rates, which reflect estimates of GDP growth and expected inflation. If something breaks significantly, Fed usually cuts rates and you'll get a curve that looks like this. So you have a drop here. But this has big duration, big sensitivity. This has, money markets have almost no sensitivity, so you can forget about that. The 2-year is the beginning of the capital market curve. Well, the 2-year has a duration somewhere around 1.7 to 1.8, which means a 100 basis point drop would increase the 2-year by 1.8%. But the 30-year has a duration somewhere around 17. So a 10 basis point drop increases this bond by 1.7%. 100 basis points to get 1.8, 10 to get 1.7. So imagine if you had a 100 basis point drop on this curve at a duration of 17%, right? When trying to beat a benchmark, do portfolios include all the securities that constitute the actual benchmark? Yes, they do. Sometimes they do sampling. So I may be an active investor with the S&P 500 as my benchmark, and I may select 100 stocks. In other words, my weighting on the other 500 is 0. So that's an active weight. It's just I'll have a whole bunch of negative weights. Let's say the benchmark weight on a security was 0.012 and I had 0. I have a negative weight of 0.012 on that particular issue, and I would have much higher positive active weights on 50. But I would be sticking close to my benchmark. Couldn't they construct a portfolio with only a few selected stocks? Yep. That would yield the same risks and returns. Yeah, they could. But just to get the same risks and returns, why would I pay you a management fee to get the same risk and return I could get on my own? You got to beat the benchmark, not buy a few securities and tie the benchmark. You got to beat the benchmark, right? Does SPY ETF own all 505 stocks? Yes, they do, because it is a passive ETF that tracks the index. So they do own everything, and it's meant to be a passive approach to investing. Considering your opening comments about the economy, is your thesis about a relatively high likelihood of exogenous event-led recession still in place? Yes, it is. Somebody's trying to leave, and they're trying to open the door really, really quietly right now. You can go ahead and close that door. Go ahead. Don't worry about it. There we go. Exogenous event-led recession still in place? Are you saying to relax your views on it? No, I still think that if you keep rates this high for this long, that you've changed them so fast, you have an economy that overfit itself to low interest rates and easy money, and you have brought them away from that in a short period of time. That dislocation, and many of them believe that this is temporary, that we're only going to be here for a short period of time and then we're going to head back to the zero line. So they're not fitting themselves to this environment. Survival of the fittest, man. If they're not fitting themselves to this environment, they will not be fit for this environment. And the higher rates stay, the more of them will fail, because they'll say, we didn't adapt. We didn't adapt to this environment because we thought this was temporary. We thought all we had to do was survive here for a while and then we were going home. But we are home and we are not adapted for this environment. And yeah, I still think that it will break a significant number of things in the economy. Unless I'm correct. Unless I'm incorrect. I thought that's a weird way to start. Unless I'm correct. Unless I'm incorrect, you seem to be applying your perspective on the S&P 500 via options and futures. Why haven't you decided not to utilize options in ETF? Because options on futures are far more capital efficient. With ETF options, even if a trade doesn't work, you end up assigned an ETF with no carry. The futures have carry. So the option is on a futures price that is a good 40 points above the spot price. So I got 40 points given to me by the futures price, and since the options are centered around the futures price, not the spot price, I get another kick from the options. So the index would have to rise like 40 points just to hit the underlying price, never mind my options. So I got two sources of carry in there with much lower capital requirements. Would you mind sharing which percentage of your wealth came from labor, which one came from trading, investing, and which one from others? No inheritance. Yeah, you can cross that one off the list altogether. Labor, I wouldn't even say labor, unless you call your own business labor. But the majority of my wealth came from entrepreneurship. Hands down, the majority of my wealth. That if I did not do this, probably for the next 5 years, the best return that I would get is creating another business. It'd be education-centered type business, or maybe research-based business. And if I did one of those two things, I would do more and I would do better than in the markets, because nothing creates wealth like entrepreneurship, especially when you get it right. It's powerful. A few weeks ago, I had a couple of papers sent to you via your technical support that discuss the IRR, the accuracy of some of its implied assumptions, and its use in capital budgeting. So I do get these things from time to time, questions, and I simply don't have the time to read all the stuff that's sent to me and all the questions that are asked of me. I stopped answering candidate questions through my email a year and a half ago because it consumed my entire day. I'm not kidding you. The number of emails that I got asking me questions consumed my entire day. It was either give up everything or quit that. So when I sold the business, I made it clear that I don't want to do this anymore. I don't have the time in the day for all of these questions. But I think the problem you have with IRR is the problem everyone has with it is, why is there the reinvestment assumption? Why does it matter if it's reinvested? So I want you to think about it's a money weighted rate of return. So let's think about a portfolio, and in this portfolio you're going to hold a bond, and that bond's going to pay a coupon. Well, now you have cash. See, this bond has a yield to maturity, right? Well, now you have cash, and as you continue going on, you're going to get coupon, and now you have cash, right? So the portfolio will not realize this yield to maturity if this cash is invested at a rate lower than this yield to maturity, so that the return on the portfolio will be less than the yield to maturity. Now, that's the point, because once you put money into the portfolio, well, because this is a money-weighted rate of return, you now have more money. So the bond will have one yield. I don't know why that menu. See that at the bottom of the screen? The menu jumps from one screen to the next because I use two screens. I don't know why it does that. I try to move that menu sometimes. Can't move that menu to save my life. When I don't want it to move, it just jumps out of nowhere. It's a quantum menu. So you have more money. This will be earning a different return than this, and your return is money weighted. And that is why we say that you will realize the yield to maturity on a bond if you reinvest the coupons at the yield to maturity rate. However, you could have a portfolio with a bond and it pays a coupon, and you immediately take that coupon out and spend it. Well, then this portfolio will realize its yield to maturity. Why? Because the cash, the amount of money, never changed. So its money-weighted rate of return can only be its yield to maturity. So think about a company that invests in a project. It has an internal rate of return. And we say as long as cash flows are reinvested at that internal rate of return rate. So here's your project. And the company starts earning cash flows. Unless it pays those cash flows 100% out to you, the amount of money within the project increases. So that new money is going to have some weight in the project. And so its return there'll be a weight based on its return, and that's why we say cash flows are reinvested at the IRR rate, because as soon as you get money into your portfolio or into your business account, well, now that's more money, and if your return is money weighted, you have more money making different types of returns. I think that is your problem there, is it depends on where you leave the money. Most portfolios are built for reinvesting the cash flows because they're designed for some future future outcome, whether it's your retirement fund, whether it's your taxable fund. Not until you're in distribution mode are you actually taking it out. But most funds, you buy a bond fund, that bond fund reinvests its cash flows. So it is subject to the reinvestment at the yield to maturity rate rule because it has more money every 6 months whenever it gets coupon payments, right? How do you know when to sell? The home builders. Well, don't get greedy. I mean, my God, year to date, 40, 50, 60, 70, Hovnanian up over 100%. And at some point, you got to say, look, everyone's talking about the home builders now. Every day on Bloomberg, somebody's saying home builders, home builders, home builders, and the sector's on fire and everything looks great. Well, that's usually the time that you want to start heading towards the door. When the party's in full force and everyone's drinking, no one's real drunk yet. No one's made a fool of themselves, but now it's time to start making your way to the door. You don't want to be the last person to leave the party, right? Going back to last week's question about discounted real cash flows, wouldn't the output be a real PV? No, it would not. Wouldn't be a real PV. It would be today's price. When we say you're using real cash flows, you're using this year's quantity in your numerator along with this year's price, but next year's quantity has this year's price, and the year after's quantity has this year's price. You wouldn't result in a real price. You have real cash flows being discounted by real rates. The reals will cancel. You'd get the same thing if you tried to forecast with nominal rates. You should get to the same price. No. Unrelated to the video, but do you plan on including Excel course teaching financial modeling at some point in the applied series? That starts next August, and we are going to use a real company to do that. I'm thinking probably a home builder, either D.R. Horton or another company, any company that's easy to understand, because you don't want to start with complexity. Lamb Weston is probably a nice company to use there as well. I wanted to get clarity on the roughly $1 trillion estimated decrease in the M2 supply over the course of the next year. Is that decrease associated with the runoff securities from the SOMA? Yes, it is. Question on the yield curve. I want to know if the yield curve only tells us about the market sentiment, which is currently that the short run or short rates, money market rates will decrease in the future, and there is more supply of funds to the long end. I'd have to take a minute and think about that sentence. Is the yield curve only to gauge investor sentiment? No, it's not only to gauge investor sentiment. Any price at any point in time is a gauge of investor sentiment. All prices are a gauge of investor sentiment. All metrics. The yield curve really is, once you derive your spot rates from the yield curve, it is the price of risk-free money. It gives you the price of money for a period of time. So it's not just to gauge investor sentiment. It is the price of money. How do banks use the yield curve? That's a big, broad question that I'm not quite sure what part of the answer you want, but that's a book. That is a textbook. How do banks use the yield curve? Could you please summarize how this curve is linked to other parts of the market outlook? Well, where yields are, this sets the cost of funds. This is the beginning of the discount rate for everything that's risky, is you must first get the risk-free rate. If I can get the risk-free rate, then what discount rate should I have for equities? Clearly not lower, because why would I discount risky cash flows at a rate lower than I would discount risk-free cash flows? So it forms the basis of how you would begin to build up what the discount rate is for equity cash flows. One last question. Given the AI hysteria, could that not drive some corporate capital investment? Yeah. If mythical eventual AI-driven cash flows are perceived as de-risking, could that not just outweigh any growing discount factor by skyrocketing the numerator? Mythical AI cash flows. Well, yeah. Okay, I see what you're saying. Could that not just increase the numerator, even if it's not real? I mean, that's a beautiful thing about the future is you can't disprove my version of the future. My version of the future is just as valid as your version of the future. So yeah, I could have much higher cash flows because of that. I think the CEO really wants to put their money where their mouth is. They'd send some measurable capex towards AI-linked projects. Well, we'll see that this quarter, right? Yes, accruals are rocketing upwards. CEO alarming, earnings alarming, and clearly everyone is just riding rosy AI talk. I just see an AI story to tell that could keep the momentum up. And, well, you're not the only one that sees a story to tell. There is a story to tell. And that story will get bigger and bolder and more awe-inspiring every single day until it gets to a point where even it can't live up to itself. American markets just love to ride momentum, even driven by nothing more than hot air. Yep. And learning to never underestimate the value of bullshit in the U.S. Well, that's it, right? If you tell people what they want to hear, they will perform for you. Kathy Wood figured that out. Watching your original live Kathleen Hogs video, I was wondering, do you have to trade both substitutes? Could you not just trade one? No, you can't. You can't trade one because you don't know. You don't know if the spread. Let's say you just bought hogs, and the spread decreased because this fell, but cattle fell even more, and you bought this, you would lose. You have to buy the two of them together because you're playing the spread. So you have to be pound neutral. Pound meaning 40 pounds of hogs, 40 pounds of live cattle. That's what each contract is. You must be pound neutral, and you're just playing the spread. What if both prices go against you? That's the risk of a spread trade, is that spread could get even wider. I'm drinking, in case you're wondering, a Pellegrino. It's just bubbly mineral water. Video showing your IBKR workout layout setup. I will be. That is what the Applied series will do. It will show you how to build your own screen, depending on what's important to you. On your weekly update from this week, you mentioned you want to aggressively on the long duration trade. I want to go aggressively. Yes, I do. Could you explain which instruments do you use to do that? TLT. I'll sell puts on TLT, and I'm selling puts on ZB. ZB is the futures contract for the bond. Is it only on TLT, or do you actually buy bonds? I haven't bought any bonds. No, I could, but no, I'm not buying any bonds. On TLT, do you have any concerns with the Fed raising rates more than what they've announced? Nope. Nope. I agree with your view about the neutral rate, and I wonder if the Fed will have to go even further than schedule. I think they will have to, but again, you have an economy that has not fit itself to the current environment because many of the firms in this environment really do believe that this is temporary. Get any company, to just take a company at random from the S&P 500 and go to their most recent 10Q and read their management commentary. Usually they have a little section there on economic outlook. And they'll tell you, well, we expect this to happen this year with, and the Fed cutting rates into 2024 and unemployment. All of them, almost to a company, expect that the Fed is going to start cutting rates sometime in 2024. The economy is going to slow down and the Fed's going to start cutting rates. Almost all of them expect that to happen. So none of them are really adapting to this environment. They're surviving this environment, but they're not adapting to it. And the longer rates stay at these levels, the more unadapted they are, which means there'll be a scramble to adapt. When shorting S&P by selling calls, would you consider buying puts as an alternative? No, I wouldn't. I don't like buying puts. I sell calls. I've started using 2-day to expiration calls. So rather than S&P sitting at 44.91, I think, okay, this is the September contract. And I think, okay, well, if it gets to 45.10, I will put a little bit more on. So what I do is I use a 2-day to expiration, and I sell the 45.10 call. And I've been doing that every 2 days, and it's it's generating a nice source of income. And I would only short it at 45.10 anyway, so if it exceeds 45.10, well, that gives me my 45.10 short plus the premium. So I actually get it higher. So I've been using those to try to engineer a short position. I figured I've been selling puts behind the home builders and it's just not working for me. It never gets put to me. So I thought, hey, if the universe is treating me like that, why not sell calls on something I want to short? And I bet you I never get it. So checkmate, universe, your move. For those who like going long duration and convexity, have a look at the 100-year 100-year bond. Yeah, it trades 42 cents on the euro. 100-year bond, 0.85%. Well, I'll tell you something. There is some wicked convexity sitting in that one. Trades at 42 cents. How can you not pick up like 42 bucks worth? Like, why wouldn't you pick up 42 bucks worth and just put it in your will? And give it to somebody else or give it to a charity when you die. Like, or even pick up 420 bucks of it just for the hell of it. Just for the hell of it. Right? I mean, why not? I mean, that's incredible. Can anybody buy it, or must you be Austrian to buy it? Or can anybody buy it? That is incredible. 100-year bond. Can you please explain what the Bank of Japan's yield curve control is? That means they're buying and selling bonds in such a way that they keep a yield on a 10-year at 0.5 or lower. How the carry trade is affected by the yen strengthening. Well, if you borrowed in yen and invested in Mexican pesos, for example, if the yen starts strengthening, it's going to take more and more Mexican pesos to pay back your loan because you borrowed in yen. So you do not want the yen strengthening, because you're going to have to cash out of your Mexican pesos and buy that yen before it gets too expensive, because your loan is in yen. And that means that your loan is getting more and more expensive because the yen is rising in value. So that means the value, not just your interest rate, the value of your loan is increasing. It's appreciating. So you got to get out of that. What are your thoughts on tobacco stocks in this market environment? Oh, they're smoking. I love stupid jokes. They're smoking. They're lower duration versus most other equity stocks. Yep. I believe that. Yep. Pay generous yield. Yes, they do. They are cigarettes. When I say cigarettes, cigarettes are cash cows. Anything like this is a cash cow. They run the risk of next generation products not panning out, resulting in even lower terminal value that's already priced in. Potential menthol bans nationwide. You ban menthol, I don't think that you ban that you kill smoking. They'll just move to something else. So, product elasticity increasing faster than expected, but I've never really looked at tobacco stocks. I think that cigarette companies are usually subsidiaries of other companies. I don't know if there's a pure play cigarette company out there, but it's not something that I've been drawn to. What data reports do you look at to gauge housing supply versus demand in the U.S.? You can just look at the existing supply of houses. So the number of houses available for sale. Add that to new home construction, and then compare that with household formation. Should be household formation is about 1.2 million per year. So the stock of those two should be, at least equal to the 1.2, if not in excess of it. What if markets trade at a high PE for the next year? What if even with a recession we trade at 17? Well, 17 is a multiple of 4 lower than where we are. That's 800 points lower than where we are. So yeah, we would get a drop in prices. Why the short position if you're expecting an earnings beat? I'm expecting an earnings beat with a cash flow miss, a huge cash flow miss, and revenues that are uninspiring, revenues that come in below the rate of inflation. So you'll have maybe 4% growth in revenues, quarter over quarter, below headline inflation. You'll have the gap between net income and cash flow from operations widen even more, which means more accrual accounting going on to beat the numbers. Because my theory, or my thesis, runs like this. If the multiple on the market were 17, companies wouldn't have to work so hard to make earnings because the multiple is low. The quality of the earnings would be better. But to justify the higher multiple on their stock, well, they do have to report earnings. Otherwise, they're going to get sold off hard. So they do have to make their earnings. And if they can't make it with cash flows, if they can't make it with economic activity, they will make it with accounting, which means the quality of their earnings will be lower. So I think they'll make it with lower quality earnings. Whether the market is willing to pick up on that or not, I don't know. Would you consider selling puts on SPY to be a stable long-term strategy? Long-term, yes. Yes, I would, because if it is put to you and you have 10 or 15 years, I can tell you in 10 or 15 years, SPY will just be higher. If you get assigned, you simply own shares of the United States economy. Yeah, I agree. In what section of the applied series will you put the analysis paper critics in? I did the. It's a 44-minute video of that Fed paper. I walked through the whole thing for you. At least the major sections. Spending more time on the methodology so that you understand the methodology. It's in the market outlook in the applied series. I'll be putting more in there, and these will then also form the basis of the paper reviews for the charter holder package, which will be out later this fall. Could you explain what pre-market and intraday mean? Pre-market means that you can trade before the market opens. You're trading before 9:30. In some stocks, you can start trading them as early as 4 a.m. in the morning, like Tesla. A lot of the Nasdaq stocks, Tesla, Microsoft, especially if they're held globally, they start trading at 4 a.m. Futures trade all night long. You can the real pre-market, if you don't want to trade at 4, starts at 8 a.m. You can trade from 8 to 9:30. Intraday means 9:30 to 4, means during the day. And then you have post-market, which is all the way to 8 p.m. at night. But liquidity is not that great at 4 in the morning or at 8 at night. Given what we saw with the held-to-maturity controversy, could accounting tricks cause a similar vicious sell-off? Well, held-to-maturity is not an accounting trick. That's an accounting standard. It's not an accounting trick. If I'm holding a bond and I intend to hold that bond all the way to maturity, the matching principle says I must match my revenues and expenses in the period incurred. Since I'm holding it all the way to maturity, I should match the amortization of that bond to each period, not the fair value fluctuations, right? So because I intend to hold it all the way to maturity, I should amortize it. I should be agnostic to what fair value is. So it is not an accounting trick. It is an accounting standard that makes sense. What would those catalysts look like? So no, I wouldn't say that the held to mature. I wouldn't point to the held to maturity as being something. I would look at the level of accruals that are happening now, and I would say, well, maybe if we dig around in there, maybe there's something going on in there. I don't know. Given 1 to 5 real year and break-even rates, do you consider tips a good place to be? If you think that inflation over the next 5 years will be higher than the 5-year break-even rate, then yeah. If you're a bond investor, you'll do better with tips. If you're a bond investor. But if you have the choice of being in the equity market or the bond market, you must first make that choice of where you want to be. So it's not like it's going to be better than anything. It's just if you are in the bond market and you're going to buy a 5-year bond and hold that 5-year bond to maturity, and you think inflation will be higher than the break-even rate, then buy the tips. Let's see. City Commodity Strategist is bearish on oil prices for 23-24. I would like to start long position on energy stocks, but I'm wondering if I should wait a few months to get in. Yeah, you can be bearish on oil, but keep in mind there are two sides to that equation. There's demand and supply. So you can be bearish on the demand for oil, but to draw a straight line and say I'm bearish on the price is to ignore that there's a group of producers on the other side that will manage the supply. OPEC will just cut. OPEC plus, I should say, will just cut. They'll just cut production to keep a tight market. So you can be bearish on the fundamentals and say, from a demand perspective, I'm just not seeing growth in demand. I'm seeing some demand destruction. You can't just leave it at that and say the price is going down. You then have to assess what the supply destruction is going to be before you say it's going down. So, I wonder in his conclusion if he is accounting for anything on the supply side. In your analysis, is there any chance we run the risk of deflation sooner? Yeah, you could. We could actually be in a deflationary economy globally. We could, and that could show up with a vengeance. However, I do think it'll take time, because you've gotten a lot of companies used to a diet of fat margins. They're not going to give up those fat margins easily. They'll try everything they can with price. They'll try shrinkflation. They'll try managing their costs down. They'll manage their inventory levels below what's necessary. They'll try to make sure they have no excess inventory, back to just-in-time inventory, not just-in-case inventory, to try to keep those margins alive as long as they can. So, but, I think a big problem we're entering, and if you go back to my market outlook videos and the applied series videos I did on YouTube for free when I was putting them out on YouTube for free, it was about 2 years ago. I had made a prediction that the future is going to be about large cap, because just the economies to scale. The point of economies to scale is so much bigger now because you have diminishing marginal costs. Digitization allows you to have diminishing marginal costs, not increasing marginal costs to scale, but diminishing marginal costs. So you have an economy in which you have a number of small businesses that simply will never be able to compete with large businesses. And that's going to continue. We are moving to what is called large firm capitalism. I wish I could find the video, because I just thought about it now, that I could then put in the link, but I would have to go through so many of them. But in one of them, I did say that the future is going to be large cap, simply because of that trend towards diminishing marginal costs. There are no penalties to size. There are only benefits to size at this point in time, and increasing benefits to size. So I do expect, probably over the next 4 or 5 years, a major hollowing out of small business in not just in the U.S., but in most Western capitalist countries, and a skew towards large firm capitalism in most of these countries, kind of what Japan has, but for different reasons. Japan has it because it's brutally difficult to even start a business in Japan. So it's, you could get deflation if you have an increase in competition. But I think that the future holds a decrease in competition, not an increase in competition. And when you get a decrease in competition, you will get a fight by the companies themselves against deflation. Let's see, being short in the run-up to earnings season. Earnings quality in the past 2 seasons were not good. Current market is optimistic. On top of that, you're expecting more accounting manipulation, low-quality earnings. Unless something groundbreaking happens, why would the market give up that optimistic sentiment? Yeah, well, that's exactly where I am too. Is I look at that and I say that's why I didn't roll over my June positions, because I thought the optimism is just too high. AI, and by the way, did you hear about AI? And we have a guest coming on that's going to talk about AI. And we have a housewife who's going to tell you how AI has improved her life. AI. Oh, and I don't know if you heard AI. And it just never ends. So I don't see that ending. And I think, as I said in my Sunday Outlook, I think the mentions of AI in earnings season are going to be off the freaking charts. Off the charts. But in the background, you are going to see, I think, more deterioration in earnings quality. That cannot hold. at some point somebody's going to pay attention to something there. If not investors, at least the SEC is going to start saying, should we be looking at something? Like, do we want another repeat of 2000, 2001, 2002, where it was scandal after scandal after scandal? If earnings deterioration is happening and it's getting worse, shouldn't we at least look at it, right? Somebody somewhere is going to say, shouldn't we at least have a peek? Maybe there's nothing going on. I'm not saying that there is widespread fraud going on. I'm not saying that. But, if I were the SEC and I saw this happening and that spread getting wider and wider, I would say, can we just throw a few people on this and let's just look at a few things, At least I would be doing that. But I would hope that the conversation starts about the earnings quality. I would hope, and that the smarter people in the room look at that and say, maybe now's the time to give up and move out of these things. Wouldn't market rally based more on superficial good earnings? Yep. I think it would. I'm hoping it doesn't, but that's the possibility. How do you reach a conclusion to be in a net short position? I have over time learned to trust my gut. That if something doesn't feel right here, if I got a sneaking suspicion, I'm usually right. My timing sucks, but I'm usually right. So I try to take timing out of it, and I say, well, at what point do I want to be in, and how quickly, and how much do I want to be in by? And I am comfortable with this position because all my external money is long only. So honestly, I don't think I can lose on this one. Just pride. Just pride if I'm continually wrong. In 6 months, if I have to abandon this again, it's just pride at that point. Shouldn't you be neutral? At a portfolio level, I'm very close to neutral. At least wait till earnings season is over to be net short again. Well, you have to invest on the expectation, not the result. And my expectation is that the divergence in earnings quality is going to start to show up on some radars, and all you need is the conversation to start. Not one person or two people to pick up on it, but it to become part of the conversation. And once it becomes part of the conversation, then you'll have more people saying, look at this company, for example. When we saw it report earnings, you saw a $2 billion difference between net income and cash, and we saw a huge increase in inventory. Well, when you have an increase in inventory, you know what goes in there? All the wages, all the overhead, everything for the production facility goes onto the balance sheet, not the income statement. You still have to pay salaries, and you had to pay utilities, and you had to pay all the overhead, but you didn't have to charge it to expense because it's wrapped up in inventory, right? You got rising inventories. That is an accrual. Rising revenues, but rising accounts receivable. Well, there again, no cash showed up, right? So it's things like that. So I want to be there in anticipation that the smarter part of the market will start to have that conversation. I could be wrong. Considering you have been either short or negative for almost a year, you must see significant downside to SPY to short. What is your target price? 16 times forward earnings, 14 times. You tell me what breaks, and then I'll give you a target. You speaking SPY 380, 360. Here's what I think right now. I think that a revisit of 41 isn't unrealistic, given how far we've run and how far we've gone. A lot of it on AI hype, a lot of it on the Magnificent Seven that they're being called right now. That some kind of correction seems to be in order if you think that the second half of the year can continue on. Because you got people saying, I'm not getting in right now, I'll wait for a pullback to get in. So that if you really want the next leg up, you almost have to have a pullback to get that next leg up. That just for the health, I would seem to think a revisit to the bottom part of the upward channel around 41 is not unrealistic given how far we've run on how little, right? But, you tell me what breaks, and then I'll come up with a price target. If you were to reverse the time and be in your 20s again with the knowledge you have now, that is the only condition I would go back to my 20s, is with the knowledge I have now. I would not want to go back not knowing that I have gone back and repeat it again and run the risk of making stupider mistakes, or taking the wrong turn and being somewhere not like here, right? Would you keep the same investing strategy you use now or apply a different one? Knowing what I know now, I'd keep the same one that I have now. Yeah, I'd keep the same one I have now. You'll see the strategy I use as we go through the portfolio management section, because I will give you exactly what I do. I will show you exactly what I do, and then you will decide what parts of that portfolio you think are right for you. As being bullish about agency, what do you think about the leverage position agency? Given high rates, wouldn't the rates increase the funding leverage costs? Yeah, it would. That is a risk. They do have interest rate hedges in place. They do have fairly low funding costs, but if their costs increase, and we do expect a stable environment, it just means that you can just increase leverage. You decrease leverage in unstable environments, and you increase leverage in stable environments. It does not matter what the level of interest rates are. If you expect them to be stable at that level for a period of time, you can increase your leverage. I don't quite understand fund flows. Why are we seeing inflows into bond, but bond market is down, but outflow from equity equity market went up? Can you explain? Not really. The bond market will respond to and even though we're seeing, you might see the bond market is down, I'm not really seeing that in TLT. Like if you look over a period of a month, it's kind of just going sideways. It's not really going up or down, but kind of going sideways. When money buys a bond, the bond market's not like the equity market. There's not a lot of trading in the bond market. There's a lot of buying, and then that's it. So you get a one-time boost in the and you don't really have the type of options plays on bonds that you do on equities, where just the buying of call options can force the underlying price to go up, because there's so much more volume in those call options. So you don't have the same kind of market dynamics in equity markets that you do in bond markets. So it's when we say that we watch funds flows, all you can do is watch fund flows into ETFs and mutual funds, but you don't see them going into options, because it's zero sum. Yeah, $10 went into the options market, but $10 came out because you bought something for 10, you had to pay somebody that 10. So you don't see the full effect of all of those options, but they will have an effect on the underlying security, because the market maker has to buy or sell to hedge, right? What do you think BTB REIT at these levels? Their customer base is fairly solid. I think their rent collection is always like 98-99%. But they do have a lot of retail exposure, and they have some office exposure, so they are going to be thrown out with the group. I do own some of this in my TFSA, only because it is just such a great income producer. It just generates a dividend every month. It just generates a dividend, and it's cheap enough. It's cheap enough that it doesn't bother me. I have it. I don't know that I would add to my position. If around 5% is our new neutral rate, then 10-year rates around 3.5 cannot be this low and should increase. Yep, that's true. If we accept that 5% is the new neutral rate, if in fact we find out that there are no lags, the economy is this strong, it's that resilient, and interest rates mean nothing, if we find out, then the neutral rate is 10%, 20%, 30%. It wouldn't matter. if the economy is insensitive to changes in rates, it wouldn't matter what it is. But I do think, given the financial sophistication of the world today, the neutral rate is higher than what the Fed believes it to be. This was already answered here, so I'll leave that. Why go bearish when we have a slew of economic data this week? And I've already explained that. What's your opinion on holding Canadian bank stocks? I've answered this. I have TD and BNS, and TD had a beautiful day today, up $1.30, $1.40. Will you do an update on Tesla? Not really. I don't know what more to say about Tesla. It's, as far as a company goes, it's a good company with a good product. It's just not worth the multiple it's trading at. And I think that the investor base in Tesla is far too eager to believe that every single bit of news is bullish. Everything you can say about Tesla is bullish. They lowered their prices. Well, that's because they're going to go for market share, and then they're going to raise their prices after. Well, their margins are dropping. Yeah, but he's doing that now so that he can have bigger margins later. It's no matter what you say about it, they only have 2 cars. Yeah, but they're holding back on that to flood the market with those so everyone sees it, so that they have the same look, and then they're going to introduce 50 cars. Okay, well, they say they're going to have full self-driving for 10 years. They haven't. That's because he's holding it back so that he releases the most perfect version of it so that nobody can catch it. No matter what you say about Tesla, the shareholder base turns it into a bull story every time. So how do you, it's not worth the multiple, period. It is trading purely on I don't want to say euphoria or hype, but purely on brand. Is that I don't have the words that I'm looking for. It's just trading purely on a story that they want to hear. And the people who are putting higher and higher price targets on it, because you got to hold Tesla if you're in the S&P 500. You have to have some kind of holding on it, and it's a big one. So you don't want that thing falling. So what you want to do for the rest of the shareholders is tell them exactly what they want to hear. And I think that that's probably a big part of where Tesla is right now, is you have fund managers that probably have to hold it, don't like the idea that they have to hold it, but are far more willing, or really willing, to tell all the retail investors exactly what they want to hear to keep the price there. Because it's just hard to understand why you would still keep thinking that in 3 years they'll be generating $50 billion in robotaxi revenue when they're only at level 2, or their software's at level 2. And, you can just ask some questions that I don't think are unrealistic to ask. If, in fact, they do have the best technology in terms of full self-driving, and they do, in fact, have the best data in terms of full self-driving, then where is it? Other companies have it. Where is it? If it really is the best, and they got the best data, shouldn't they be all over the place with it? But they're not. So, again, you need a Tesla shareholder to tell you why that's bullish. Oh, it's because, and of course it's going to be a bullish story where Tesla owns 100% of the market. So no, I'm not going to do an update on Tesla. My views on this are known. I think it is its multiple is going to have to come in line with its operating earnings, its margins, and its margins are going to drift towards the rest of the industry. They will all drift together because you can't escape the inertia of the industry that you're in. Cash flow from operations is going to take a hit, and at some point it's going to weigh on the multiple. That investors are going to start saying, well, look, I can't keep justifying 45 and 50 times earnings when the margins and the cash flows aren't supporting it. We'll just leave it at that. Does anyone know where I can source similar data? Okay, this person is asking about the UK market. The central banks don't have the treasury, don't have yield curves. You have to go to whatever the treasury is. And if you go to the exchequer, it'll tell you how to get the free data. It says go to tradeweb.com, register for free. You'll get a confirming email. You confirm that you're registered. Once you log in, you'll get a screen up. Go to the last column, which says closing prices. Look under closing prices and click on CMT rates, and you'll get the UK version of what I do on the main screen for the yield curve. And in any country that you're in, don't go to the central bank for this. Go to the Treasury. Whatever the Treasury is in your country, it will, and I think it has to, provide the yields on a closing basis for transparency. It has to provide it to you. Thinking about going long duration with Russian bonds. Oof. A similar idea of why you do it with U.S. ones. But last Q&A you said that U.S. rate hikes put upward pressure on interest rates in other countries. Isn't a true statement. Well, no, I said I don't know that that's a true statement. I don't think it is. I understand that you don't have a deep knowledge outside of the U.S. Let's imagine anyways you are appointed as head of Russian Central Bank tomorrow. Current rate is 7.5, inflation target 4. What would you generally do with rates in the next 6 to 12 months? Not a freaking clue. There is more to what's going on there than what I think based on GDP and rates and targets. There's a lot more. There's a bigger dynamic going on with all the sanctions. It's not part of SWIFT. I can't even begin to think about what I would do. So I don't have an answer for that. You said you sold 335 puts on copper. Oh, I already explained this one. I understand you do not advise, but the Fed paper end of an era and this crazy multiple I'll spy for a passive investor. How would you invest? Monthly payments over time? Stocks and bonds 60-40. I'm quite afraid of buying the market today and 3 months later, loss of 30% or more. Well, yeah, that is, I think you should start with what's your investment horizon. And if it's money you don't need for 30 years, then who cares? Who cares? Dollar cost average over the next 30 years, just buy passive indexes in the 60-40 for the next 30 years and you'll be just fine. That's it. What's this last one? Hard to read into pending home sales. Laughing my ass off. Why? Why is that funny? It is hard to read into pending home sales. Why is that funny? Please tell me why that's funny. I want to laugh too. Anyways, that's it.